Hello, good day once again. Welcome to today's presentation, how to use your real estate debt to achieve wealth, tax-free wealth for the most part, believe it or not. So very, very exciting topic. It took me a while to put together this presentation. And once again, my name is Seewing Yee from the Real Estate Network. My, I own a real estate investment club here in Northern California, San Francisco Bay Area, and we've been helping to investors to buy in different part of the country to buy out of state cash flow turnkey investment properties for to buy in whole long term. So we we move to different markets as situation dictates. So anyway, before I go any further, my esteemed guest, Mr. Richard Advani, going to help me with this presentation. He is an investment loan agent. He's just not any loan agent. He does investment loans for in all 50 states, and he has helped investors to finance their investment properties multiple times for a number of years, and he has helped our network of investors to buy out of state properties using financing, and he knows all about investment loans and all the markets. He also does owner-occupied properties and mainly in California because he's physically based out in California. But again, he's just like me. We know different markets, what's going on out there in the investment world, and we have a very good chemistry working together. So, all right, without further ado, so let me go over to today's topic. This is a very, very interesting. Let me share my screen, open up my PowerPoint, and here we go. And of course, Richard he's always has helped me with my presentation. He always provides some very good perspective because he owns 18 investment properties throughout the country, and he knows real estate, he knows investment properties. All right, so.
The best part is it's all honest advice because I never know what we're talking about until right now, which is good.
That's the fun part of it, Richard. You know me. I always like to challenge you about a lot of things, and you always come through with all the challenges. That is a mark of a real estate entrepreneur. You and I, right? We are different than most people because we always think outside the box. That's why we do what we do, and we do our best to help real estate investors to achieve their goals. Although most of them they are too scared to take the next step, but we do find some really highly motivated investors that know that just get it. That understand the you can create wealth through real estate better than any other asset class. Anyway, that's for another time, another day. So let's go over my topic: use real estate debts to achieve lifetime tax-free wealth, right? Isn't this interesting? So let's proceed. Okay, the grammar of this PowerPoint may not be all that great. I just finished the PowerPoint. I didn't do too much edit because I want to get this out there right away because this is so timely. This topic, this presentation is so timely, so I have to get it out there, and that's why I invited Richard Advani to help me present. Anyway, today we've been hearing, unless as an investor, unless you've been hiding under a rock, what's happening recently, that there are record low inventory, record low interest rate, tremendous strong demand for housing. Housing prices are rising at a historical clip. New construction is slowing down due to skyrocketing lumber prices and the a population migration in the lower cost metros as a result of remote work. So this post-pandemic crisis has creating some amazing real estate opportunities if you know how what to do, how to find it, and so forth. All right, so I'm going to give you just a mere hypothetical scenarios and assumptions. All right, so again, we are not tax advisors, and you need to consult your financial advisors to determine what's best for you in terms of investments. There are risks involved in real estate. However, do your research, do your due diligence, and proceed according to your personal goals and objectives. So again, this is just a hypothetical situation. Richard and I are not tax advisors. We are not licensed financial advisors. Again, this is just a generic theoretical presentation, although it have a lot of realistic practicalities based on the experience that Richard and I have in assisting with our investors. So with that in mind, let's go over this nice, interesting hypothetical. So first hypothetical is an investor currently makes around $100,000 in salary. This person purchased his primary home in the Bay Area for the fact that I've been living in the Bay Area for the past 30 years. So let's use example in my area, San Francisco Bay Area. This investor is making 100 grand per year. And this investor 7 years ago used a 0% down VA loan, Veteran Administration loan. Myself being a military veteran, that's what I did too. But anyway, so 7 years ago, this property was 500K. Now today's value of this home, of this principal home, is 1 million. So this investor decides to, with Richard's help, to cash out, refinance the equity from his primary home, right? And instead of sitting at his equity without any, anything. So, Richard, are you still with me?
Yeah, I am. I actually joined from my computer as well, so I can see the.
Oh, perfect. Yeah, I was wondering what's happened to my screen. Now I know. Okay. All right. So on the additional scenario, so this so Richard's assisting with this primary home investors to cash out, refinance his primary home to the tune of $400,000 in cash, and with the intention of buying 5 properties. These 5 investment properties, each is around 25% down payment. And according to my understanding, Richard said you can buy all 5 mortgages at one time. You don't have to buy one property with financing and wait 3 months or weeks and months to buy another one. And any motivated investor, they have the ability to buy all 5 investment properties all at one time with financing and still do okay. So I'm glad to hear that, Richard, and a lot of people may not be aware of this. All right, let's move on. So investor, the goal is the investor desire to pay little to no tax in his real estate portfolio during his or her lifetime. This is so interesting. Even Richard, maybe you're not going to be surprised. I'm sure you saw it before. Actually, several of my investors are doing exactly the same thing as a scenario. What I'm trying to try to articulate. So, so this investor not only wish to buy and hold forever, all the gains from all the rental properties, this investor wish to pay little to no taxes. And then once this investor passes, hopefully decades later, his estate, his asset will be passed tax-free at a step-up in basis to his or her estate and beneficiaries and children and grandchildren, whatever. So I'm talking a very, very big picture. So you get what I'm saying? What I'm trying to say is this investor or cash out refinance 400 grand tax-free. When you cash out refinance, you don't pay taxes because, that's just the way it is. Then you're going to use the leverage of debt, the leverage of this cash out refinance to buy 5 investment properties with 25% down payment. Isn't that cool? Anyway, so the 5 properties that I'm going to talk about that this investor is going to buy at 25% down payment on a loan is 1, Silicon Valley of the East, which is Raleigh, North Carolina, which is the part of the Research Triangle Park, is an Apple campus. It's going to move there, $1 billion Apple campus. So it's poised for growth. It really is the Austin 2.0. The second property is Silicon Valley of the South, which is Austin/San Antonio. This mega region, if you will, Austin/San Antonio, is going through some massive growth at this time. And the third property is, a lot of people don't know it. I mean, it's sort of a mini Silicon Valley of the Southeast, which is Palm Bay, which is on the Space Coast of Florida, which is like on the middle of the Atlantic coast area to the east, which is 1 hour to the east of Orlando. Palm Bay, Florida, Space Coast, a lot of NASA rockets and spaceships and all those kind of things. And if you have not heard, Elon Musk and Jeff Bezos and Richard Branson, the three legendary titans, they are investing billions of dollars into space ships and so forth. Anyway, the fourth properties is Las Vegas. Believe it or not, Las Vegas is really coming back. We are re-entering Las Vegas because the rent. Richard, you also need to know if you do not know already. We have not been promoting Las Vegas for the past 6 to 8 years because the returns, the cash flow is not there now. What I've heard is that the rent have exponentially caught up with the prices. So we are seeing cash flow that 25% down in Las Vegas. Go figure. Anyway, the world is full of surprises. So we are investing in Las Vegas as well with my partner there. And the fifth and final property is, of course, in Southwest Florida, which is in the Gulf Coast area, Cape Coral. So also very fast growing. All right, so we can use these 5 properties as example. All right, let's go through some more details. And I'm not gonna go over the so-called pro forma cash flow too much of it because you can, on your own, you can analyze the data. So, so Richard, so this first property is in Cape Coral, is a brand new construction, sells for around $295,000. The investors put 25% down payment, and the initial cash invested is $108,000. So, and the rent, the gross rent monthly is $1,700. So you have a decent 5% cap rate. So you do a 5% down payment. Hopefully my loan scenario is realistic. Richard, you may say something about it right now. I know the interest rate changes all the time. Or if you look at the right-hand side, the interest rate on this 25% down loan, assuming the investor qualified with very high FICO score, whatever, I put down what did I put down here? Let me take a look. Oh, I might have did a little bit wrong. I put it 3.2. Maybe that was a few months ago. What is the current interest rate on an investor mortgage at 25% down typically, Richard?
They've moved up very recently, so a little closer probably to 3.625 to 3.99. So a little higher than what you have on there.
Typically on a 1 to 4 unit, is that correct?
Correct.
Okay, so this cash flow is a little bit off. It's okay, but look at the big picture. Okay, don't dwell on the numbers. Look at the high level. Look at the 30,000 foot view of my presentation. That's all I ask because I have a point to prove. Anyway, so when it's all said and done, based on a $1,700 gross rent monthly, so when you factor all the numbers, the monthly net cash flow is $172. Nothing to to dwell about. But Richard, I'm sure you agree, because of the rising housing prices all over the country, it's really, really hard to get high cash flow, especially when you talk about new construction areas in the south and southeast. But this is maybe I'm thinking in the next 2 to 3 years, depending on a specific market, I believe investors need to really refocus their philosophy instead of buying strictly for cash flow like we have in the past. The next 2 or 3 years to take into consideration that the rising appreciation of prices, we need to reprogram our brain into thinking as an investor, you should buy, as long as you can get slight positive cash flow, maybe even break even, maybe even slight negative cash flow, as long as you, the equity play, the quote unquote equity appreciation will more than offset, the low cash flow. So we'll discuss more about that. So Richard, I know you've been doing a lot of investment loans on a consistent daily, weekly basis. Your investors come to you to get financing. What have you seen in terms of what I just said, in terms of that we need to, at least temporarily, to focus more on appreciation projection as opposed to high cash flow in this fast growing, markets that I just discussed.
Yeah, just really that. I mean, with the cost of lumber going up and building materials and supplies and just overall home prices, right? Home prices have been going up year over year. I know we've kind of are getting to a point where we're seeing kind of a ceiling here in California and places like New York. But the interesting thing is all these markets, most of the markets we're dealing with across the country are still going up 5, 6, 7, 8, 10% a year. And then on top of that, you throw in the all-time lumber highs and prices. It is getting harder and harder to make cash flow and to make big cash flow. The only chance you can get big cash flow is on more of these turnkey properties, which are great investments, but not quite as passive as new construction, which is what you're talking about. So yeah, at the moment you have to take much lower cap rates than we're used to. However, the growth potential, especially given that lumber prices realistically aren't going to come back down to the prior levels, the overall growth and appreciation is kind of the new play that we need to make. And it's important, obviously, in doing that, to buy in strategic areas like you're working with. Not buying a home just anywhere at an elevated market, but buying it in markets that have been vetted and that should still have growth opportunity. And I think in a lot of these markets, for example, like this Florida property you have up right here, the price is probably dramatically higher than it was 2 years ago. But I don't think the rents have caught up yet, and they still are going to, just like, as you said, you're seeing in Vegas now that, the rents are catching up now, and all of a sudden the properties are generating a lot more cash flow. And then the last thing I'll add is this, from what I've seen on the flyer you provided, and most flyers out there for properties and pro formas, they don't really take into account the return on amortization. And what I mean by that is you're actually paying down your balance every year as well, or rather the tenant is, which typically will add 1 or 2% to your cash on cash return numbers if you factor that in. And once again, it's the return on amortization, the fact you're paying it down. So all in all, I think, you're in a point right now where everything's kind of peaked out and high. The stock market's at, the highest place it can be. A lot of rental real estate has gone up as well. But you're still able to get an actual return on these properties, where it's getting harder and harder to find a return. And then, in my opinion, inflation is coming, and having a low 30-year fixed rate on these new construction homes is definitely a good hedge against that inflation.
Oh, absolutely. I mean, this is just amazing. Where nowhere in the world where in the U.S. where we get a 30-year mortgage fixed at the current rate is just amazing. It's just like almost like free money. So again, the theme of this presentation is using quote unquote free money, also known as leveraging your mortgage debt to achieve financial wealth. So, all right, thank you for your quick comment, Richard. I totally agree. So let's move on. Okay, this is the fun part. Okay, for each property, I'm going to make some projection. Again, I don't have a crystal ball, neither does Richard. So we're just going to do some, play. Let's have fun and sort of play this game a little bit and use some, personal thoughts and projections. So my thought is I'm using a 3-year scenario. Why 3-year scenario? I think because in many markets, in particular the 5 market I just spoke about, the supply of inventory in any given week and recently is like 1 to 2 weeks supply of homes, right? And the normal market in any market is 6 months supply of homes that will give you break even supply demand. So because the supply is so low relative to the 6 month, the normalization equilibrium, I believe in some of the market that I'm promoting, it'll take 2 to 3 years maybe before supply catch up with demand. So during those 2 or 3 years, Richard, I'm sure you'll agree with me that the price will continue to rise, and that's why we need to capture the next 2 or 3 years of rising appreciation as an investor. then after that, we may see a slight correction, meaning, look, it's not going to be any kind of crash. Okay, we don't have enough time right now to talk about the crash. With the other podcasts, Richard and I did discuss a little bit about, the all this kind of future projections. But it'll be a slight correction, a few years down the road. The correction will be just very modest, maybe no appreciation for a couple of years beyond at that time, maybe 1 or 2% appreciation. But I don't see a dip in home prices, because the demand will always exceed supply, especially in the market that we just talked about. But anyway, all right. So here's the scenario. Okay, on this first property, Cape Coral, I'm projecting 10% appreciation for the next 3 years. So if you look at the screen, you will clearly see the market value of this property, $295K the first year. At the end of the third year, I couldn't even see the number because our picture is affecting it. Don't worry about it. Okay, everyone else, you see it on the screen. You see the equity growth. So the key, the line you should see is, you see the fifth line. It says potential cash out refinance. So if this property grow at 10% appreciation per year for the next 3 years, we're talking 30% appreciation rate. You have in this property $170,000, $580. The cash out refinance to potentially to buy more properties using this equity growth in the next 5 years. And if you look at the loan to value, is all the way down to like less than 50% loan to value. That can give you justification to do a cash out refinance. Richard, again, another reason why it's so important for you to be on this presentation. As an investor, as a rental property, what is the minimal loan to value ratio before someone can cash out refinance the equity?
On a single family home, it's 75%. So we can cash out up to 75% of the value. For a multi-unit, it is 70%.
Right. So, okay, you saw the market value at the end of the third year. So you do so in this hypothetical situation, that this investor is using loan to value of less than 50%, so they can cash out 170K. So the full value of this property is how much is it? Close to 400,000. So 70% multiplied by the market value at the time of your refinance. Then how do you come up with the cash out refinance amount in this particular scenario, 170K? So what is the formula for that?
Yeah, I mean, it would be basically, we would take 75% of the appraised value minus the existing lien, and that would let us know exactly how much, obviously, the client would be able to cash out.
Right.
Yeah, so, just what you have there.
Very good, very good. So this is a potential, exit strategy investors could do with this property. However, at the lower, at the bottom of this graph, we also show if an investor were to sell this property at the end of the third year, the proceeds after the sale would be $182,000. You see that? Now, the question is, yes, you could sell this property. If you sell this property $182,000 and just pay the capital gain, who knows? The capital gain right now is 20%. You have to pay, 20% federal, maybe state capital gains tax as well, depending on your state. I don't know. So, 40, 50 grand could be paid in taxes if you were to sell this property, and you still going to profit. But if you do a 1031 tax deferred exchange, the amount right here, proceeds after sale, $182,000, are not going to be taxed. The tax will be deferred as long as you buy like kind replacement property, to replace this property, and you're not going to pay any capital gains. I know we're not going to have time to talk about 1031 exchange. So you have three scenarios, right? That the scenario at the end of the third year, if you as an investor will do nothing, you can allow this property will continue to grow, cash flow and equity wise, or you can cash out refinance because you have plenty of equity because you have 10% growth appreciation in the past 3 years. You can cash out this $170,000, cash out refinance to buy several more properties, right? You can buy more and more properties, cash flow, hopefully a property somewhere in a country, and so forth and so on. All right, so okay, let's go on with the second property. The second property located in San Antonio, Texas. San Antonio, Texas, I believe is the really is up and coming, because the Austin market right now is really becoming unaffordable because of the tremendous rise of appreciation. I do not recommend real estate investors to enter the market right inside Austin, because the median price of Austin right now is around almost $600,000. You believe that? A mere 2 years ago, the median price of a property in Austin is only 400K. Now it's up to like 600 grand. It's just amazing, fast growth. So again, investors that entered the Austin market 18 months ago or prior, you made out like a bandit. Okay, you should be laughing your way to the bank, but now no longer. You need to go outside Austin, like 1 hour below Austin, which is in San Antonio, and the median price of San Antonio is so low. I see some epic, influx of people moving into San Antonio, because the affordability is so much lower than Austin, and it's so close, only 1 hour away. So I see some tremendous boom going on in San Antonio. So I'm targeting this market. I've been targeting this market for many years. Right now, the numbers works. In this case, this new construction is only 235,000, right? And you could get it rent for $1,750 monthly. So you put 25% down payment. You still have a good cash flow monthly, $278. Right? Again, you chase appreciation. So my projection for San Antonio for the next 3 years, similar 10% appreciation for the next 3 years. We're gonna, again, the exit strategy is similar to the previous property I just talked about. You look at the value at the end of the third year. If you want to cash out refinance, you have a good amount. You're right. You have a slightly higher than more than $100,000 to cash out refinance this property if you want, right? And buy a couple more properties to leverage. Or you can do 1031, which I do not recommend, right? I do not recommend you selling your investment property too early, right? When you sell any kind of property, investment property too early, Richard, my philosophy is you can kill the goose to lay the golden egg. You want to keep your property as long as possible, hopefully for a lifetime, because you can trigger cash flow, you can lay a lot of golden eggs, because this goose will continue to lay eggs. So that's the key to long-term buy and hold investments. So, but if you want to cash out refinance because of the rampant appreciation in San Antonio market in the next 3 years, fine, do the same thing, right? So you can continue to buy more property using leverage, using the power of good debt. Again, cash out refinance, there's no taxes. Richard, think about that. When you became a loan agent, Richard, years ago, what the thought of using appreciation of your property, cash out refinance, is tax free. You don't pay taxes on it. What other asset that will provide you with this amazing benefit? Can you share a simple thought about it?
Yeah, I mean, just as you alluded to, there's a couple things to keep in mind when accessing homes equity. Is firstly, it's the cheapest place you're going to find money, period. Just because home mortgage rates are obviously the lowest period out there. And then also on top of that, it really is, like you said, the only means where you can access that amount of cash at a reasonable rate, and not have to pay taxes or not have to pay capital gains. So it kind of allows you to have your cake and eat it too, where you don't need to sell the property. You can leverage it, and then use that and deploy that to purchase additional rental properties. And once again, avoid paying any taxes on it. So it's definitely a good tool, and I think something a lot of people overlook when it comes to investing in real estate.
Exactly. So one more thing. Again, I'm not a tax advisor. However, whether you have break-even cash flow monthly or even slight positive cash flow, $200 or $300 per month, if you look at it, I know everybody's tax situation is different, but there are so much tax write-off associated with real estate investments, because you're getting the paper write-off, the passive losses, the depreciation, right? So when it all said and done, although on paper you may be paying, you may be getting $400 per month positive cash flow that equal to maybe $6,000 per year of annual net cash flow. But this kind of cash flow you pocket into your pocket is you probably, when you file your tax return, if you use a good tax advisor, you may not pay any taxes at all on this cash flow gain. Okay, so for that reason, I'm maintaining the title of my presentation today. Even with positive cash flow, you most likely will pay little to no taxes because of the depreciation tax benefit associated with owning investment property. So your equity grow tax free, right? All like always, and your presumably low cash flow, you don't have to pay taxes. So I mean, what more can you ask for? This is too good, right? All right, Richard. So next property, the third property is again Las Vegas. It shocked me because I have not been promoted Las Vegas. Now I'm back because you look at the numbers, right? You look at this single family home in Las Vegas, a resale, maybe 10, 15 years new, right? At let's say 300,000. And I was told you're getting a monthly rent of $2,200. Yes, that's what's happening. You have many people with high salaries are moving to Las Vegas because of remote work situation or whatever. They're still making 100 grand or 150,000, but there's lack of homes to buy, not only in Las Vegas, in most good markets, most any kind of real estate markets. There's so few homes to buy, and people have to relegate it to renting until they can afford to buy a few years later, or until there are enough inventory for them to buy, because right now you're getting multiple offers everywhere. A lot of people getting outbid. So the $2,200 of rent, you are really getting a lot of it. There are many renters, as a matter of fact. There are Richard, I'm sure you might be aware of it. There is a bidding war. There is a bidding war for renters. For every investor that closed escrow in the past 12 to 18 months within my network, Richard, the market we just talked about, even before they close escrow on these homes, there are like 20 to 30 rental applications fighting to rent this one house. Is that amazing?
Incredible.
Incredible. So you think there's a bidding war to buy houses? There's bidding war for people. There's a shortage of single family homes to rent. So people are fighting tooth and nails, your tenants. So people, new investors ask me, what about the rental market? Or rental market has been right now is the best ever that I have seen in my career for investors. All right, anyway, so $2,200 monthly rent, 25% down payment. The property tax in Las Vegas is only about 1%, which is amazing. So if you look at all the debt obligation on the left-hand side, at the end of the day, at 25% down payment, at 3.5% interest rate on a mortgage, this house is getting almost $400 positive cash flow in Las Vegas. I mean, that kind of surprised me. So that's why we are re-entering Las Vegas. Richard, have you heard? I mean, Las Vegas for the longest time, the rent have not caught up with the rising prices in the past 10 years, ever since the downturn in 2008. Have you heard about this rent to value ratio in Las Vegas is really converging itself in a positive way? I mean, have you heard that recently?
Yeah, I have, and that kind of leads back to what you're saying, how there's almost a bidding war for tenants right now at property. So, inherently, obviously, prices overall are going to go up. As the bidding war, and just imagine the first time that happened, right? Now, the next person that goes to lease is going to look at the rental rates that, the last house that got rented got, and well, that house had a bidding war. So, it pushed the rents up. So, inherently and organically, the rest of the market is going to follow. And like you said, it also started roughly last year, where it was really, really aggressive in terms of tenants versus availability. And, generally organically, that takes a little bit of time to overall affect the market with rents. But, as you were talking the last couple of minutes, I got to say, I wasn't completely there because I Googled this property right away that you have pulled up. Because I myself am like, wow, okay, you know, you can make some cash flow. It's in Vegas. It's close to California. It's in almost a brand new home. I mean, based on the snooping I'm doing online, it's granite, marble. It looks nice. We may need to talk offline.
Absolutely. You know, actually, this is it's amazing. I mean, I have reconnected to my Las Vegas realtor. We have done business over the years, but not in the past 6 to 8 years because I thought you cannot cash flow in Las Vegas. We've done several podcasts already. Mr. Glenn Plantone, very good friend of mine in Las Vegas, he's showing me. I mean, he's selling cash flow homes as we speak. He had fourplex, a renovated fourplex in Las Vegas, close to the strip. You know, kind of old, but it's been renovated for like $500,000 fourplex, and it rents for $4,000. I mean, $1,000 per door. We're talking, you put 25% down payment on this fourplex in Las Vegas, and he get cash flow per month, like $1,000. We're talking 8% cap rate, cash flow in Las Vegas on a fourplex. Is that amazing? This is kind of deal. That's what's going on in Vegas. It just blew my mind. Cash flow is coming back big time in Las Vegas. I mean, which is good. But from here in the Bay Area, you know, you take an hour and a half flight, a hop, skip, and jump to fly Southwest Airlines from San Francisco to Las Vegas. You know what I'm saying? I mean, gosh, it's just like next door. You can buy a property next door to you. Southern California, take what, on a Southwest Airline from LA to Las Vegas, take about 30 minutes, right? On the flight?
Yeah, 30, 45, give or take. The actual in-air time's like 20 minutes.
Yeah.
By taxi and stuff takes 45.
Right. But if you drive from LA to Las Vegas, like 3 hours, 3.5
hours? Not bad at all.
How many hours?
3.5.
Oh yeah, that's really nothing. Anyway, okay, let's continue. We can talk all day because there's so much good deals I've been talking about. All right. So anyway, this property have good cash flow. Again, we expect, you know, my projection in Las Vegas, once again, 10% annual appreciation on real estate. So once again, at the end of the third year, as you can see, the value has grown. Then the loan to value is, you know, at the 50% mark. Then the number shows the potential cash out refinance is 148,000. Once again, potentially investors can cash out refinance, just suck money, 148K. They can buy 2, 3, 4 properties against tax. That's how you see this domino effect. You know how a real estate investor can quickly can increase their real estate portfolio to multiple doors above and beyond this initial 5 property foundation scenario. You see it's too good right now. I mean, for right now, to me right now is the best time to be a real estate investor. Okay, I mean, a lot of people may not have $400,000 of cash, right? But I have a 5 property scenario, but you can use 1 property scenario and achieve, you know, the same thing, albeit slower growth. But, you know, anyway, so as you can see, again, this before and after situation with each of the 3 property, you have 3 choices. Do nothing, allow your property to increase in cash flow and appreciation for long term, or cash out refinance at the end of the 3rd year, or do a 1031 tax deferred exchange and not pay the capital gains and buy multiple replacement properties to trigger a 1031 exchange, or to outright sell your property at the end of the 3rd year and pocket the profit and pay your taxes. So actually you have 4 exit strategies. Okay, so here you go. I mean, you know, we have some great options. Okay, the fourth property we talk about is Palm Bay at the Space Coast, right? In Florida, again, is a lot of things happening. A lot of people does not know about the Space Coast, but you know, you need to do more research. I'm not going to spend too much time on it. The property is new construction. We're working with a built to rent investment model with this builder. You know, the built to rent model is becoming very popular these days, where builders only build their new homes for investors only, right? So just keep this in mind. Built to rent business model is up and coming in this investment world. Richard, you also need to be on top of it as well. So this property is very good price, even at below market value. It's a 4-bedroom, 2.5 bath, like 1,700 square foot in Palm Bay, Florida. At only like 235,000. I'm sure the prices will go up very shortly because of the high lumber costs. So your initial investment is only like $63,000 down payment. I'm using 25% down payment. The taxes are low. The debt obligations are low. And then at 25% down payment, you're getting a cash flow monthly net of $418. So it's really a good bargain to buy a new construction property here. So, and we look at the, again, 10% appreciation per year. That's my projection. At the end of the third year, you see the numbers. My recommendation is, although I give you 4 exit strategies, if you will, you should do a cash out refinance, take this $100,000 cash out refinance this house to buy 2 or 3 properties. And then, okay, so the numbers are really off the chart, as you can see, all right? So, all right, let's go on and let's do the final property, the 5th property in this acquisition portfolio, and then we'll conclude within 5 minutes of this presentation. And the last but not least property I'm projecting is in Raleigh, North Carolina. In case you have not heard, this is the Silicon Valley of the East. We believe the Apple have a $1 billion campus. They just announced it's going to be built in Raleigh at the Research Triangle Park. So this is really up and coming. I see this Raleigh market similar to Austin. What had happened to Austin 18 months ago. So just keep that in mind, what I just said, right? I mean, which is truly amazing. So my projection on this particular property in Raleigh, like 10 miles from Research Triangle Park, I'm using 15% annual appreciation projection for the next 3 years. So before I do that, again, the kind of property you should buy is like $300,000 right now, and these prices are going up on a weekly basis. You know, my local network partner in Raleigh, Mr. McVicker, who I'm working with, he said a lot of these homes right now, every week they have increased by $20,000 and $30,000 on a weekly basis. I mean, he's telling me in real time. This is a real time scenario. By the time this house is, this type of homes I'm presenting right now, 300 grand, it'll be 330, 350 in a few months. That's how it is. Okay? Right now, in that market, there are about 5 to 10 offers per house. I predict in 3 to 6 months in a Raleigh, North Carolina market, there may be 30 to 50 or even more offers per house. All right, read my lips, investors. Okay, get in Raleigh early as you can get right now. Okay, and pull the trigger because this market will not wait for you. The 3,000, just the Apple employees, there are 3,000 Apple employees can occupy this new campus in a few years. But right now they're already there. They're already going there. These 3,000 Apple employees, each making $187,000, are already entering the marketplace even before the new $1 billion campus is being built, right? So this is just one example. There are many other high-tech companies are already there. And the many more high-tech companies will come into the Raleigh, North Carolina area right now in the next few years. So things are about to happen. Things are hot. Things are going to be insane for the rest of this year in Raleigh, North Carolina, Raleigh, Chapel Hill, and Durham. This is the tri-state area within 20, 30-mile radius of the Research Triangle Park. And this market is exploding. The houses right now, as you can see, is break even. The rent is only like $1,700 for right now, but the rent will increase in the next few years, okay, beyond $1,700. So right now is only a break even situation. It's fine, right? Break even is fine, nothing wrong with that. So he's a performer. Then let's look over the 3-year scenario at 15% appreciation. I'm using a more ambitious projection, because let's run the scenario, and who knows, at the end, the next 12, 24, 36 months, we're gonna go back to my presentation today to see whether my projections and predictions are correct or not. So I can't wait to see the next 3 years as I look back right now, starting today. Richard, today's the 11th of May 2021. You and I, let's go back to this presentation 1, 2, and 3 years later from now and see whether my hypotheses in my assumptions is correct or not. All right, so let's come back to this later. Okay, so anyway, as you can see, at 50% appreciation per year, the next 3 years will be 45% appreciation. Yes, very ambitious. You see the equity growth, right, from 300 grand to almost $450,000 in market value at the end of 36 months. Once again, you have the potential cash out refi number right here, almost 200 grand. You can cash out refinance to buy multiple properties, leverage through the debt, leverage through the good debt. The good debt is your mortgage, your real estate mortgages. Other kind of debt or bad debt, credit card debts are bad, student loans debts or bad debt. Richard, you should know that you're in your loan business. You understand what I'm talking about. All right. So again, here's in recap. Okay. So you start out with this scenario. You start out with 400 grand of cash. After 3 years of holding period, I add up all the cash out refinance money you can pull out from these 5 properties at the end of the 3rd year, 772,000. How many properties can you buy with $772,000? I mean, you don't have to buy $300,000 investment properties to leverage from this cash out refinance. You can go to Midwest market somewhere. You can go to Buffalo, New York, in our market, where you can buy a 4-plex for $180K, where you can buy a duplex for $60,000. Richard, you know that. You have done a lot of financing for our investors in Buffalo, Niagara Falls. In that market, you have a lot of cash flow. So investor, this chunk of money, you multiply, money grows on trees. You multiply this cash you have leveraged through debt, through additional mortgages. Look at the numbers. You can buy high cash flow properties in the Midwest, Buffalo, Niagara Falls, or other Midwest cities with high cash flow to offset your break even or slightly negative cash flow from this 5 market. So you have a balanced portfolio, right? So again, to recap, the initial money, the 400 grand coming from your principal home, which in this case, this investor bought it with 0% down, nothing out of pocket from the get-go, and you turn this zero money down for this investor 7 years ago into a multi-million-dollar portfolio. You could invest over time for the rest of your life, cash out refinance, tax-free, no taxes. Then when the investor dies, the beneficiary get a step-up in basis that will inherit your property with no taxes. It's a generational transfer, legacy transfer to caring for the wealth. This situation being built on this investor's lifetime can potentially become a multi-generational wealth transfer for these particular investors and their legacy of growth for the family, children, grandchildren, and even beyond that. So now you understand what I'm trying to say. This is getting so excited. I'm getting the chill talking about this. This is not theory. This is real, potentially real stuff. So before so Richard Advani, what is your high-level thought as to what I just said throughout the entire presentation, the presentation itself, from your perspective as an investment loan agent, that you potentially have the ability to help these investors in this situation to cash out a refinance on a systematic, strategic basis. Your job is important. because you have, as a lender, you have to do all this kind of cash out refinance. So tell me the balancing act an investor have to go through to make these loans and cash out refinance and this kind of things happen. Tell me from your perspective, how you as a team member can help this investor to achieve this lifetime dream of what I just discussed.
Yeah, I think firstly, you covered obviously all of the strategy as well as the good points in terms of leveraging and using your home or using your investment property to purchase additional rentals. In terms of broad level strategy, interest rates are still very good right now. So oftentimes you can accomplish lowering your rate with getting that cash out, which of course you're going to redeploy. Other than everything you've covered, I don't think you have too much to add except for, definitely reach out to me if you guys do want to explore kind of employing this strategy, cashing out on some of the properties where you do have equity. And then, of course, we can use those to identify properties in Seewing specific markets that you guys want to invest in. But one thing to note, obviously, as well is it is important to, employ this strategy within your comfort and tolerance level as well. Neither Seewing or I are saying go and max out your loan to value on every single property you own and pull all your cash out and buy a lot more. But there is a conservative way to do it as well. I mean, a lot of us out there have, property between our primary home and other properties, potentially $1 million worth of equity or hundreds and hundreds of thousands. So conservatively taking out some of that to redeploy to create, in fact, more cash flow and diversify and kind of spread your risk is a good strategy to employ.
Yep, sounds good, Richard. Thank you so much. I mean, I will provide Richard Advani's contact information on this video. No need for Richard for you to disclose your contact information. But nevertheless, Richard Advani, he's the owner of Supreme Lending, and he's very successful as what he's doing. He has a large staff. He knows how to do investment loans in all those markets, whereas most loan agents do not. So, my network continue to use him. So we work as a team. That's the key. So Richard, your investment strategy is a very important part about real estate investors. A team, a network, a team to help them achieve their goals. So once again, this presentation have went longer than expected. Richard, I know you're very, very busy. Really appreciate your time. You're very busy processing loans every single day. Thank you for your input. Very, very good perspective. And we're going to continue to do podcasts together to talk about other real estate investment topics. Other than that, thank you for listening. This is Seewing Yee from the Yee Real Estate Network. Thank you so much and good luck. I'll see you on the other side. Have a nice day. Bye-bye.